On one hand, we have Cathie Wood and Elon Musk banging pots and pans, screaming about how the Fed is going to force us into deflation, which will require the eventual return to a similar amount of money printing to stimulate the economy again that led to the disaster we're in now. And on the other hand, the Fed finally put out the truth. They put on their big boy pants, strapped up their boots, and said inflation is out of control. We've lost, and we're finally going to be real with you about the trajectory and terminal endpoint of where we think interest rates will go, even though that could end up being worse. Hey everyone, Meet Kevin here. We are facing lots of pain. We are facing a disaster because, quite frankly, inflation, while it came down in July, didn't really do great in August. And unfortunately, when we take out some of the largest contributors to inflation, pretty much like everything, like food and shelter, energy, used cars and trucks, the chart that we end up with is pretty miserable. It's this right here. Shout out to Bloomberg for this. Look at this, folks. It is inflation that is still uncontrollably rising. And this is why the Federal Reserve is suggesting it's time to change our definition of what we're actually trying to accomplish, because clearly what we have been doing hasn't been working, or at least it's not working yet, which is clearly the argument that folks like Elon Musk and Cathie Wood are taking, that, hey, we gotta be careful here because if we over-tighten, we are going to usher in deflation, the likes of which the world has not seen since the Great Depression. Remember, a recession tends to be 2/4 of negative GDP, but a depression can oftentimes, even though there's no clear definition, be more than 4/4 of negative GDP growth. And quite frankly, with what we're seeing in markets now, it wouldn't be a surprise that we go from the 2/4 of negative GDP that we already have to another 2/4 of negative GDP, potentially not only resetting markets, but leading to quite a depressing environment, either actually or just mentally. But one of the most important things that we have to realize from what the Fed told us yesterday is we're flip-floppers. That's what they told us. Because see, the Federal Reserve first told us we want to see core inflation go down. The chart I just showed you, we want to see that go down. Then it turned into, well, we want to see both headline and core go down. Now, the Fed is changing their minds again. The Fed is making the argument that we're not even worried about inflation going down, even though that's the number one priority. But what we're actually going to use to measure our success is, instead of being inflation, we're actually going to measure our success by the impact we are creating on the labor market. Yes, that is the other half of the Fed's dual mandate. One half being get prices stable, and the second half being ensure or try to get to maximum employment. Well, we are so far to the other end of maximum employment right now, that is to the extreme beyond end of maximum employment, that we have about 2 job openings per employee willing to work. And this creates a lot of demand for labor. And in January, when I first warned about what the absolute worst thing is that could happen with the Federal Reserve, it was what's known as a wage price spiral. This is when prices go up, so workers demand more pay. When workers demand more pay, companies seek to maintain any kind of semblance of margin or profit. So what do? They raise prices again. But then things get more expensive and the workers raise their demands for wages again. And this is how you get a stair-stepping or spiraling of prices just going up. And they don't just go up once to where you have a year-over-year high comparison and then it drops off and you don't really have inflation anymore. They keep going up. And so yesterday, the Fed pulled off another great flip-flop on us. They made it clear that we are going to focus on reducing job openings. Unfortunately, the only way to reduce job openings is to make companies feel like they're running low on money or access to capital. And the stock market is the biggest source of capital for companies. So stocks go down, companies feel like they may have less access to capital, consumers may spend less money, creating less demand for products, hopefully leading companies to finally shut down some job openings. And when those job openings shut down, then maybe we'll see the JOLTS indicator come down. We'll also potentially see the quits ratio come down, which currently sits at about 2.7 to 2.8%. And the reality is, if people are still quitting at a rate of 2.7, 2.8%, it means that they're not worried about finding another job. It means they could easily find another job, right? Which again means too many companies are hiring. So the Fed's pulled off another beautiful flip-flop on us, and this is leading to substantial uncertainty and lots of red in the market again. And it's not just the United States. All of this is compounded by an extremely challenging macro environment where the entire world is conducting synchronous interest rate hikes. Even the Bank of England today coming in with a 50 BP hike, although not as large as the 75 is expected, still a relatively large hike. And the world is slowly moving away from the days of ZIRP, zero interest rate policies, ZIRP. Except for, of course, China, but then again, China is probably in a depression, a severely devastating economic environment where even though China has started 52,000 infrastructure projects this year, they are still seeing a decline in construction, property investment, and land sales. That's pretty scary. So, in other words, if you're not like raising interest rates right now, you're just getting screwed. And if you are raising interest rates right now, you're also getting screwed because you're trying to crimp down on your economy, get people to spend less money, and reduce people's wealth. And one of the greatest drivers of wealth is, of course, the housing market. And this is why yesterday, Jerome Powell told us that he expects a, quote, difficult correction to come to the housing market to bring housing prices back in line with affordability. In English, price is going to go down. So, what do we have? Well, we've got a Fed that once again flip-flopped. And markets need to price in this new flip-flop. So if you're wondering why things are red, it's because markets have to price in the new flip-flop. Take a look at this chart. This chart shows you a blue line. The blue line tells you what the market's expectations were for the Federal Reserve's peak rates. And the market believed, oh, okay, so we'll have peak rates over here in March of 2023, and then they'll come down. After the meeting, the market also believed that rates would peak in March and then come down. That's signified by the orange line. But as I said yesterday when I covered the Federal Reserve, yo market, apparently you're missing the beat here because the Federal Reserve is making it clear they really don't intend to U-turn until likely the end of 2024. See this period right here? That's called higher for longer. And that's because we're probably also seeing inflation that is higher for longer, and a decline that is coming later than expected. And unfortunately, this section right here, the difference between where the Fed is likely going with Fed rate policy and the orange line is signified by one thing, folks: pain. Pain in the stock market. So, what do you do about this? Well, I think there are three things that you can do about this. The first thing that you can do is you could consider getting into treasuries. Treasuries are something that we're talking a lot about and we're likely investing in via, or with, I should say, with HouseHack, because HouseHack is my real estate startup that we are hoarding cash for. So that way, when the real estate market corrects, we can go buy real estate at the bottom of the market. Accredited investors can join me now, and if you join by September 30th as an accredited investor at househack.com, you just upload W-2s or income statements or whatever, accredited investor letter from investready.com. You can do that all at househack.com. You will get founding shares in this company that is going to go buy, not now, we're not catching a falling knife with HouseHack, but when the market is lower. And with HouseHack, we are going to deploy, likely, a good chunk of the cash that we have in things like 6-month treasuries. So that way, since we don't plan to buy for 6 months, we sit in treasuries for 6 months, yielding somewhere around 3.9 to 4% on an annual basis, doing nothing. If you invest $25 million into treasuries at 4%, you make $1 million per year, literally doing nothing. Could you imagine that? $1 million per year doing nothing. And you could have founding shares in this company. If you're not an accredited investor, stay tuned. I'm hoping to get accredited investors involved as soon as maybe even December or January, we'll see. So treasuries are a very interesting product to look at right now, especially if you buy shorter term treasuries like the 6 or 12 month treasuries. So that way you don't actually end up being subject to market risks, right? Because if you hold your treasury to duration, it doesn't matter if your treasury on the open market becomes worth less or more. If it's worth more, you could sell it for more of a profit. If it's worth less, you just hold it to maturity and you get your payment, right? So one of the safest places, in my opinion, to go right now is treasuries. However, treasuries come with an opportunity cost. And for personal investors, that opportunity cost might not be the best decision. It's the best decision for house hack because house hack isn't designed to invest in stocks. It's designed to prepare to invest in real estate. So it makes more sense for house hack to sit on cash or treasuries. However, for personal investors, there's a good chance that it makes sense to either sit on cash or recession-proof stocks, which I'm going to talk about 3 or 4 different stocks here in just a moment. Cash is beautiful because it increases your access to opportunity. Now, something we talk a lot about in the Stocks and Psychology of Money course on real estate or on stock investing, link down below. There's also, of course, a 0 to Millionaire real estate course. A coupon code for these expires also on September 30th, so check those out down below. In those programs, we talk a lot about opportunity cost. And the cost of you sitting on cash right now is actually the lowest it's been in decades. That's because if you're sitting on cash, most people have this impression that, oh, well, cash is going to get ruined by inflation. That's only true if you're buying coffee, eggs, and food, and gas, or whatever, right? That's only true for the first maybe $20,000 of your household expenditures on an annual basis for food and miscellaneous items, or maybe $30,000, $40,000, depending on what your rent is, right? That is affected by inflation. But the extra cash you have above and beyond that is actually investable cash. So the excess cash you have becomes more powerful as stocks and real estate go down. This is why you can combine number 1 and 2. You invest in treasuries and you sit in cash and you wait for opportunities, either in the stock market, like the pain we're experiencing now, or you wait for that real estate crash that has already begun and is likely to hit peak fear in 2023. Again, the startup I'm creating is not designed to start buying homes now while people would be catching a falling knife. It's designed to go shopping when we hit bottom. And you can get founding shares in this company. Just go to househack.com, read the solicitation. Number 3, your next option is recession-proof stocks. Recession-proof stocks. This is interesting. Let me give you an example of what I believe is not a recession-proof stock. Polestar. See, every morning when the market is open, I try to do a fundamental analysis with course members on either or both real estate and stocks. Today, we took a little bit of a look at Polestar, and boy, we did not actually have to go that deep. While Polestar's production is low, it's kind of like Tesla in 2015 levels, its gross margin has declined over the last year from 6% to 5%. Now, sure, some of this may be due to inflation or employee costs going up or commodity prices going up, but the reality is, they lost over $500 million in just the last 6 months. And that's not even including their listing expense and conversion fees between some of their other shares. I've already taken that out. They also have roughly as many current liabilities as they have cash, suggesting they're potentially getting close to running out of money, which explains why they just opened 2 new credit lines with Chinese banks for another $200 million. And the Chinese are very smart. They're not lending a blank check here. The reality is, companies with low profit margins and operating losses are going to face massive hurdles in a recessionary environment. And that's because as stock prices fall, these companies' ability to go to the stock market to raise money will fall. And unfortunately, if you're a company like Polestar, going to the market to raise money is kind of exactly what you're trying to do. I hate to say it, but they literally tell it to you on page 7, you don't even have to get in pretty deep, of their latest foreign report or report on foreign issues. Polestar continues to finance its operations primarily through the issuance of equity instruments, and then of course debt and other things. Well, that becomes substantially more difficult to do in a recession. Again, if you want to be part of these live streams, which I think are phenomenal content every single day the market is open, in addition to all the lectures we have, use the coupon down below before September 30th and join me. Like, my goal is during these painful times to provide even more value. And we've got a whole bunch of new lectures coming out totally for free for course members as well over the next couple months here. So stay tuned. Really excited about that. Now, other companies that potentially face severe risks in this sort of recession are companies like Open Door, which I believe may go bankrupt if they have to end up taking a $10 to 15 to 20% write down on their housing inventory, while their current and long-term liabilities are equal to about the same valuation of properties they had at the beginning of the year. But you take a 20% write down on your assets and your liabilities stay the same, you could be upside down to the tune of $1 to $1.5 billion. And then you try to go access the market with shares worth $3 a share, you're going to look worse than Ape or AMC today. But boy, oh boy, did I get hate for selling Ape, APE ticker symbol, at $8.09. And now it's in the $3 range. Sorry, the writing was on the wall for it. I tried to give my warnings, but all I got was a bunch of people with Ape in their bio telling me how much of an idiot I am for suggesting that an $8.09 stock probably wasn't worth $8.09 and that it was probably going to trend towards $1. And boy, oh boy, doesn't that suck for the apes. I mean, hey, you know what? Whatever. Sorry, my heart goes out to you, but it seems like every hate comment I get on the internet these days is from somebody with Ape and AMC in their bio, or people sending gorilla poop to Citadel, which that honestly is actually kind of funny. Anyway, then you have companies on the other side of the spectrum that are actually potentially making things worse for the Federal Reserve. There are companies like American Express and Tesla and Enphase who presently, even though Enphase is, I think, going to have a hard time when the housing market falls, so a little bit of an asterisk there, but you're going to have companies like Enphase, Tesla, and American Express who are still hiring because they want to be growing in this environment, and they are still growing in this environment. That is remarkable. See, even though these companies will get smoked during this stock market downturn, fundamentals should set them up for a greater squeeze than any kind of squeeze you could hope for by a short squeeze. These are real fundamental squeezes that are being set up. And in my opinion, there is an opportunity to deploy cash into companies that, in my opinion, will survive an earnings recession quite well. At the same time, retail has not capitulated yet. And unfortunately, the fact that we're approaching levels of being within 4.5% of the bottom of the market could send signals to retail that, we might have to prepare to capitulate because this pain is just going to keep going. However, so far, retail has given us no sign of capitulation. Instead, retail keeps buying. In fact, retail spent $2 billion flowing into the market yesterday. That's above the usual $1.2 billion inflow pace. And investors who are generally more conservative over at Schwab and TD really began ramping up their purchases during the August dip. Now we're in the September dip. Anyway, there's also quite a low allocation to cash by retail investors right now, which kind of implies we could be a little bit more subject to capitulation when and if prices keep going down. The current top buy the dip stocks, according to retail investors, averaged out over the last 5 days, and thanks to VandaTrack, are as follows. FedEx, Netflix, Adobe, Twilio, who just laid off a ton of people, Moderna, Starbucks, their sales are sucking right now, Roku, who for some reason during an inflationary environment wants to get into manufacturing TVs, Tesla, Alcoa, Oracle, NextEra, Block, Apple, PayPal, Rivian, Boeing, ChargePoint, Coinbase, Uber, and Roblox. Kind of interesting. At the same time, we have margin levels going down, which I personally am actually kind of satisfied by. I like to see margin levels go down because, I don't always like to pat myself on the back, but I will say I've been saying get out of margin since November of 2021. That's right, that's the peak of the market. And the reason I said get out of margin then is because when you are in euphoric times, it's much easier to fall hard. So you get out of margin during euphoric times. Now, that does not mean I am advocating to get into margin yet. In fact, I don't know if I will ever advocate getting into margin. I don't like margin. But margin balances are falling, which is very, very nice. We're now steadily under there. That's $700 billion level in margin, and hopefully we see this decline back to 6 to maybe 550. Those were levels that we saw before the pandemic. So, a lot of pain in this market. The Federal Reserve has flip-flopped again. You really have 3 choices: cash, treasuries, or buying the dip in stocks. If you're an accredited investor, you have the opportunity to get founding shares of a company that I will make no money in until your shares double after an IPO. How great is that? In other words, when your shares double and we IPO, which means you can dump, that's when I get paid subject to severe lockup agreements, which mean I'm stuck on the ship for at least another 4 years, which I want to be because I actually think the ship is going to be like the biggest ocean liner, cruise liner ever of a real estate company in America. Maybe I have grandiose dreams, but, well, I do. Real estate is me. So I'm very, very excited, and I'd love for you to join me in househack.com. If you are not accredited yet, fear not. I promise I am doing my absolute best to get you in this cycle. If you want to learn more, go to househack.com. This video is not a solicitation, but househack.com is. And since the market is so disheveled, I too have made sure my hair looks nice and disheveled. Thank you so much, and good luck out there.